Hello, everyone, and welcome to an all-new episode of OIC's Wide World of Options. I'm your host, Mark Bezaquen, and we've hit the ground running in 2026, meaning that trading volume continues the strong momentum from last year. And to me, that signals two trends. Number one, investors are turning to the markets more and more, and a lot of those investors are choosing to invest with options to achieve their investment goals. Now, when these goals include generating premium income derived from selling options, they're likely to discover, if they haven't already, the expertise of today's guest, Dr. Alan Ellman, president of the Blue Collar Investor Corp. Alan, thanks so much for joining me. Wonderful to see you again, my friend.
Thanks, Mark. I always enjoy speaking with you and members of your team.
Well, we appreciate that. Thank you. Alan, let's go ahead and dive right in. Income generation. It's one of the leading objectives that investors use when it comes to trading options. Two cornerstones of this, or I should say, two cornerstone strategies when it comes to income generation is covered calls and cash secured puts, which I know is your bread and butter, central to your education mission over at Blue Collar Investor Corp. So, with that in mind, when people come to you and say, Alan, I'm interested in generating income with my investments, I've heard about covered calls. How do you explain to them what covered calls is? How do you educate investors how covered calls operate?
Well, covered calls is a great option strategy to start with. First of all, our government and every broker allows us to use it in self-directed IRA accounts because it is both intuitive and low risk. Now, Mark, it's not no risk. So it's important to know what the risk of these strategies are. So covered call writing starts with this. Let's break down the term covered call writing. Covered means you know your cost basis. You buy the shares first. Now, when you're selling options, you're buying shares in 100 share increments. So you buy 100 shares of stock. Now you are covered. You know what you paid for that stock, or you know what the price of the stock is at the point in time that you're going to execute that covered call trade. So that's step one. Now,
Okay.
once covered, then you sell the option. And you sell an option agreeing to sell your shares at a price that you determine, which is called the strike price, by a date that you determine, which is known as the expiration date. I deal predominantly with 1 week and 1 month, so weekly and monthly options. I don't go too far out into the future because, in my view, it's very important to avoid the risk of earnings reports. So I'll rarely go out further than that. So when you're selecting strikes for covered call writing, you can go with an out of the money strike where you're agreeing to sell your shares for a higher price than current market value, or you can go with an in the money strike where you're agreeing to sell your shares for a lower price, but getting more protection to the downside while still generate that time value premium. So you can
Right.
structure your trades based on your overall market assessment and your personal risk tolerance.
Okay. And when selecting that strike price, you had mentioned out of the money versus in the money. Out of the money, obviously higher than where the stock is currently, so that's going to generate a smaller premium, a smaller return. Whereas in the money, it's going to be the opposite, larger premium, larger returns. But that in the money, it's also going to have a larger likelihood of assignment. So, how do when you educate your clients, how do you balance those two?
Well, let me start with this, Mark. You can generate a similar amount of time value profit within the money and out of the money strikes. So
Hmm.
stock is trading at 48. You could sell that 50 call option, let's say for $1.50, and you could sell a 45 strike for maybe 450. So you're
Gotcha.
getting a similar amount of time value premium. That's
Right.
actual profit. So if you sell that in the money strike for 450, you can't say that's all profit because you're depreciating your share value by $3. That
I
has
see. Yeah.
incorporated into your calculations. Now, regarding your comment about losing the shares or being subject to exercise, you have to determine whether or not that's part of your strategy. For me, I could care less. If my shares are sold, but I've generated, let's say, a 4% 1 month return, I'm happy. That was my goal. I've achieved my goal. And now the shares are sold. Okay, I'll move. There are 8,000 securities out there. I'll just move on to another one. Or maybe I'll buy it back when this option expires. So you have to determine whether or not share retention is actually an inherent part of your strategy approach.
Right. And it's an excellent point. Assignment, or any time that you're selling options, you are going to be subject to assignment. Now, it kind of has a negative connotation on the street, generally, in my opinion. And I like what you said, that, in a roundabout way, that's not necessarily the case. If you know going into your strategy that when I sell this call against the stock that I own at, $50, let's say, and I own the stock at 45, I'm willing to sell that stock at that strike price, and I have to be willing to sell that stock at the strike price with this strategy. It's not necessarily a bad thing. I like to say that when you get assigned, it typically means that your maximum return has been realized, and or your objective has been met. So it's not the boogeyman that a lot of beginning investors believe it is.
Yeah, that's true. And a lot of times people will say to me, I bought a stock at 48. I sold the 50 call for $1.50. It went to 55. So I lost, and they're going to give me a number.
Right.
Wait a minute. You didn't lose money. You made 7% that month. If you're choosing between Kleenex and champagne, I say champagne. you know and people have to understand, when you have a strategy that you're using and you set a goal to achieve X amount percent return, and then you've achieved it, it's an exercise in futility to then say, well, wait a minute, I could have made more money by using a different strategy.
Right. Right. And when it comes to selecting that price, what's important is the comfort level, because that strike price is going to be the price at which your shares get called away. The comfort level with that price where those shares are called away. If you're not okay to sell the stock at $50, maybe 52 is a better strike, maybe 54 is a better strike, but you need to have that comfort level when selecting that strike price, because that is going to be your obligation. Should you receive that exercise notice, you're going to be obligated to deliver stock at that strike.
Well, I think the key is, and that's excellent point, but the key is to determine ahead of time, what is my goal? How much
Hmm.
am I looking to achieve? So let's say my starting point with monthlies is 2 to 4% a month in time value, whether I'm going out of the money or in the money. For weeklies, it would be a 0.5% to 1% a week. So that's my goal. Now, if I go out of the money, well, you have an opportunity for a second income stream, share appreciation from current market value up to that out of the money strike. If you sell an in the money strike, similar time value return, but now you have an insurance policy to the downside in the form of intrinsic value. So if your overall market assessment is uncertainty or bearish or volatile, you probably go with an in the money covered call. If it's a normal 8 to 10% a year to a bull market, well, you're going to go out of the money. Keeping in mind, you've already identified what your return goal is, you've already identified your personal risk tolerance, and you've identified your overall market assessment, and boom, that'll lead you right to the strike that is specifically right for you.
Yeah, perfect. Thank you. I do want to, I do want to mention two things. Number one, what you're getting at is something that we say all the time: plan the trade and trade the plan. So I love the idea of make sure you have your objective in mind, make sure you know where your comfort levels are, your risk tolerances. You had thrown out some percentages, up and down. That is going to vary from investor to investor. There is no one size fits all necessarily. But the idea that I do want to stress again is that, plan the trade and trade that plan. Make sure that you know what you're getting yourself into, and that you trade accordingly and you manage that position accordingly. Now, if we do get assigned, again, as we had mentioned, that's not the boogeyman, that's not the bad thing. If we do get assigned, one of the things that I love about selling strategies is we can take that money that we collected when we were forced to sell our stock, and now we could put that in another income generating strategy, and that's the cash secured put. What can you tell us about that?
Yeah, if I could just throw out one more point.
Yeah, please.
When your strike is expiring in the money, in other words, the price of the stock has gone higher above, let's say, an out of the money strike you sold, and subject to exercise, you can always buy back that option. You can,
True.
you buy back and you can avoid exercise 99% of the time. You also have to keep an eye on ex-dividend dates and things of that nature. But if you really truly want to hold on to that stock, and again, for me, I could care less. But let's say it was important to you, or perhaps you own it at a very low cost basis. You don't want to deal with any negative capital gains issues. You can just before 4 p.m. Eastern time on expiration Friday, just buy back that option. You can roll it out to a future date, either to a higher strike or the same strike. So you can avoid that. So I just wanted to throw that in, make sure
Yeah.
viewers understood that.
Yeah, absolutely. Thank you for that clarification. Yeah, so it's never, it doesn't have to be a done deal. Um, uh, so yeah, I appreciate you clarifying that. Now, if you're okay with getting that stock assigned and getting those shares called away, now you've got all of this cash in your pocket from the sale of those shares. A cash secure put is something that other people look to do to keep that income stream generating, but churning by selling additional premium. Cash secure put. What's your take on that?
I love the strategy. As a matter of fact, a lot of people use cash secured puts, including me, from time to enter a covered call trade. That's referred to as the wheel strategy. I refer to it as the put call put or PCP strategy, which I think is more descriptive, but it's known as the wheel strategy. When you sell a cash secured put as opposed to covered call, where you're agreeing to sell your shares, here you're agreeing to buy shares. And again, you set the strike price, you set the expiration date. Now, the broker is going to want to make sure, since you're undertaking the contractual obligation to buy shares at a certain price by a certain date, the broker is going to be sure you can afford to buy those shares. So it's going to require you to set aside a certain amount of cash into your cash account. Now, the formula is the put strike minus the put premium times 100 times the number of contracts you sell. So that's the cash secured aspect of the strategy. So in order to sell the cash secured put, you're not buying the stock as you do with covered call writing, but you're setting aside X amount of dollars based on that formula into your cash account. So that if the put is in fact exercised, you can afford then to buy the shares. Now, in the BCI methodology, I use only, or 99% of the time, out of the money cash secured puts at a lower strike than current market value. So let's say the stock is trading at 75 and I sell the 72 out of the money put for $2. That would be a typical traditional cash secured put trade that I would make, where I'm generating close to 3% in premium. And unless you're integrating exit strategies, that's the max return.
Right, and so you're in a sense creating the opportunity or creating the possibility of buying stock at a discount. It's trading 75 currently. We used to have a saying on the floor, I like it at 75, but I'd love it at 70. So, kind of the same thing. You're looking to buy it at a discount, and that cash really covers your obligation. With the covered call, your obligation to deliver those shares upon assignment was covered by you already owning that stock. It was collateralized ahead of time. With the cash secured put, it's doing the exact same thing. Your obligation to buy those shares upon assignment is collateralized by depositing that cash in the account, to making sure, as you had said, your broker makes sure that you can afford to buy those stocks if you got assigned on that. So how do we choose strike price? You had said that you're always looking at out of the money. To me, the strike price with the cash secured put, that's where I want to enter the stock. Stock is trading 75. I choose a $70 strike. That's where I'm willing to get in. Obviously, it's going to be a little bit lower because of the premium that I'm collecting will even lower that cost basis. Getting away from a rule of thumb, because there really isn't one, in my opinion. Do you have something that you look at when choosing your cash secured put strikes?
I do, and it's very similar to covered call writing. I first determine the amount of percentile return that I'm seeking with my trade. It's the same for puts as it is for calls. 2 to 4% a month, 1 to 2 for monthlies, 1 to 2%, excuse me, 0.5% to 1% for weeklies. Now, as you said before, and it was such a strong, good point, Mark, that one size does not fit all. And to prove that, I trade differently in my mother's account than I do in my own account.
Yeah.
My goal in my mom's account is 1 to 2% a month when I'm doing monthlies. So it varies, and I archive this all over my website. That I'm happy to share what I'm doing, but some of our members and members of the OIC community may want to take more risk than I take or less risk, and so you could determine your strike prices based on the amount of risk you're willing to take. The more risk you take, the greater the premiums. The less risk you take, the lower the premiums. So to get to your answer for the what strike, determine your percent return that you're seeking, and that will lead you to a certain strike. Now, let's say, again, we're in a very difficult market environment. Uh, let's say it's uncertain or volatile or bearish or whatever. You want to take on less risk, then go deeper out of the money, accept less premium return. So maybe instead of 4% for that month, you'll go to the 2% end of the range. And so that will lead, it's really not that difficult. If you set aside what your goals are, and then you pick a strike that meets those goals, boom, there's the strike right there.
Hmm.
Not rocket science.
Right. And again, having that plan and that objective in place ahead of time helps you choose that strike price. So I like that. Yeah, again, we're back to the plan the trade and trade the plan. So terrific. Now, uh, kind of similar to covered calls, what happens when we get assigned on the cash secure put? Now we're forced to buy those shares. Now we've got stock in our account and we just kind of rinse and repeat, right? We get assigned on the cash secured put, we sell a covered call, get assigned on the covered call, we sell a cash secured put.
Well, yes, yes, and mostly yes, and a little bit no.
Okay.
Because I avoid earnings reports. So,
Right.
if I own the shares, if I own the shares when there's an upcoming earnings report, I'll do one of two things, Mark. Either I'll sell the stock because I don't want to incur the risk of an earnings report. Because
Hmm.
sure, you and everyone at OIC and everybody listening to us now have seen the damage that a disappointing earnings report can do. Now, if we're doing these low risk option selling strategies, covered calls, cash secured puts, that means that we're conservative investors. We don't want to incur a lot of risk, and we can avoid the risk of earnings reports. We know when they're coming out, it's public information, and we could just avoid it. We could sell the stock. But if we want to hold on to the stock, if we have a lot of confidence, if it's a stock that historically has beaten at these market consensus at earnings reports, fine. Hold the stock through the earnings report. Don't cap it with a covered call. And then after the report comes out, hopefully you got a significant amount of appreciation, then write the covered call. So it's not like you're just constantly doing it. And another thing is, if you really want to retain the shares, you should also avoid ex-dividend dates, which is the main reason for early exercise
Hmm.
of these options, call
Yeah,
options.
yeah, I like that. Two caveats, if you will. Excellent. Thank you for clarifying those. Um, excellent information, Alan. I really appreciate you, sharing your knowledge, your expertise with us. Blue Collar Investor Corp is your business. BCI, as we're all familiar with. So, thank you for joining us. Thank you for explaining the concepts of these two widely used strategies. I don't want to let you go just yet, though. If you have another couple minutes, I want to pick that brain of yours and get to know you a little bit more as a person. Some silly questions, if you will. What's your favorite sandwich, if you don't mind my asking?
I don't mind you asking, but you're going to get a boring answer. I'm not a foodie, Mark, and I eat very healthy. So I am so limited in what I eat. So I mean, I don't even eat sandwiches. I'm going to go back to an old staple from years ago and
Okay.
grilled cheese with sliced tomato.
Oh, love it. Excellent. That sounds good. And no tomato soup to go with that?
Not bad. Not bad.
Terrific. Let me ask you this. Are you, I'm assuming you're fairly tech savvy. Your phone, what's your most used app?
Oh, that's an easy one. Um, I use Pandora. Are you familiar
Hmm.
with that?
Yeah, absolutely.
I start my day every day. I go to the gym and I'm in the gym for about an hour. I have my phone with me, my headphones. I plug in Pandora. I have my own music and it gets me through a workout like that. So
Do you listen to music or do you listen to podcasts or
I listen to music. I have, with Pandora, you create your own station. So you
right, yeah.
put whatever artists, whatever songs you like, and then it'll use that initial knowledge to generate additional songs and artists along
Yeah,
the same lines. And all you do is click a thumbs up if you like it, a thumbs down if you don't.
right.
And after about a month, you have a station that plays only the music you like.
Yeah, I love that. Speaking of music, are you a karaoke fan? If so, what's your go-to karaoke song?
Actually, Mark, I have a karaoke machine in my house.
Would you demonstrate for us?
That going to give you an absolutely no one. But we have had karaoke parties over the years, and big hit, let me tell you.
I'm sure.
All right, so let's see. Okay, so sometimes my wife Linda and I will break the ice because you know how people are, they get embarrassed,
Right.
want to get up in front of. So I say, okay, Linda and I will get up and we'll do a song to break the ice, and we do Sonny and Cher's "I Got You, Babe."
Oh, I love it.
Okay,
It's
then
terrific.
I'm doing it myself. Um, "Daydream Believer" by the Monkees. I love
Oh,
that.
by the Monkees, written by Neil Diamond.
Yeah, right.
Yeah.
Neil wrote
Yeah,
that.
wonderful. I love that. Speaking of Neil Diamond, there's a new Neil Diamond movie that just came out recently. Do you have a favorite movie that's, off the top of your head?
Uh, well, yes, I do actually. A movie, uh, Field of Dreams by Kevin.
Oh, yeah, very well familiar with it.
I'm a big sports fan and
I was gonna say I see the Yankees pictures in back of you. Yeah.
born in the Bronx. It's in my blood. I can't get rid of it. Yankee fan. I have to tell you, the scene where he says to his father, "You want to have a catch?"
Hmm.
I cry every time, and I warn
Right.
myself ahead of time. Don't cry this time, but I do anyway.
No, I get it. Yeah, that's certainly a tearjerker movie.
Mark, about movies. It doesn't exactly line up with your question, but I think one of the greatest movies from a technical achievement perspective was the original 1933 version of King Kong.
Oh,
Because
wow.
it's only 6 or 7 years removed from talking movies. And if
Hmm.
you take a look at the special effects in that movie for 1933, I always thought that that was amazing. Do you remember years ago they used to have a show, Million Dollar Movie?
I don't know.
Okay, Million Dollar Movie was on Channel 9 or something, and they would play the same movie every night for 5 nights in a row. And that King Kong movie was on several times a year for the entire week. I watched every one of them.
I love it.
To answer your question, Field of Dreams.
I love it. Excellent. Last question. What is the best or worst advice you've ever received?
Okay, best. My father gave me this advice. He said to me, when you're upset or angry about something, don't react emotionally. Give it some time. Don't react. Think about it and come back, and then you can give your reaction. And
Yeah.
I lived on that. And by the way, thinking about it, Mark, applies to investing too, doesn't it?
Oh, absolutely.
Not to trade or invest
Yeah.
emotion.
Take
Have
the emotion out of it, 100%.
some and just live and die by that, but mostly live because if you have a good system, a solid system, you're going to win way more often than you're going to lose. As
Hmm.
far as worst advice, um, I'm going to say worst advice is the guy that told me years ago to root for the New York Jets. Been suffering for decades with that one. It doesn't see no end in sight, to tell you the truth.
I love it. I love it. Thank you. Alan, really, I appreciate this. Thank you so much for your time. Thank you for joining me today. It was terrific to see you again, as always.
Okay, I'll see you in Vegas. Thanks for the
Yeah.
invitation.
Absolutely. Ladies and gentlemen, that's going to do it for us for today. Thank you for joining Wide World of Options. Again, special thanks to Dr. Alan Ellman of the Blue Collar Investor Corp for joining us, and to our listeners out there for taking the time to support our endeavors here at OIC. If you're interested in our OIC webinar program, go to our website, optionseducation.org. Check out our events section. We've got brand new webinars for you the second and third Wednesday of each month. We also have a brand new OIC Ask Us Almost Anything call-in show, or a webinar program, I should say. That's going to be the second and third Thursday of each month. So go to the website, check those out. If you have options-related questions, shoot us an email at options@theocc.com. Again, Alan, thank you for joining us. Ladies and gentlemen, thank you. And we hope to see you soon. Best of luck trading. Take care, everyone.
Take care.